Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the stock market for the rest of 2018 and beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I'll point out the information I think is most relevant. The opinions expressed are mine and not necessarily those of Raymond James, and JP Morgan is not affiliated with Raymond James. So this quarter, I want to start with an economic update. We'll talk about interest rates, equity market assumptions, and then what investors should be doing. I don't have to tell you that last year was a good year in the financial markets. Most portfolios should have gained, and many gained substantially. U.S. markets, as measured by the S&P 500, were up just under 22% last year. Overseas assets rose more, boosted by a softening dollar. This year, we've had a return to volatility. At the end of the last quarter, the S&P 500 was just a little positive for the year, while most overseas markets were a little negative. American investors were hurt overseas by a strengthening dollar again, which increased those losses so far. Generally speaking, this year has been a bit of a roller coaster that has simply so far returned to the gate for another ride. Like it or not, the U.S. leads the world economically. When we fall into recession, the world tends to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. Year over year, GDP growth was 2.8% in the first quarter. Many economists are predicting year over year GDP growth north of 3% for the second quarter. You can see on the left-hand chart that there is an unmistakable rising trend in GDP growth in recent quarters. On the right, we're looking at components of GDP. Consumption always makes up the largest chunk in a market-driven economy. Therefore, it's important as investors to know how consumers are doing financially. Overall, GDP growth still remains low versus historical averages. Higher home values help create a wealth effect for consumers. Nothing makes consumers feel wealthier and freer to spend money than having their largest asset appreciate in value. Home values have been on a solid growth trajectory since 2012, and housing affordability remains strong. Note the bottom left chart, though. When you compare current home prices to average incomes, houses are becoming very expensive. This is good for sellers, but tough for buyers. Those who currently own homes are still experiencing strong housing affordability with low mortgage rates, reducing mortgage payments relative to incomes, although mortgage rates are rising. When the price of oil fell at the end of 2014, many rigs in the U.S. were shuttered as uneconomic at the lower prices. These shuttered rigs are still available when oil prices rise to economically feasible levels. Consumption has grown at an average of 1.4% a year historically. Oil supplies have grown at a more erratic rate. Recently, inventories have fallen with a dramatic increase of demand in China primarily, and that has allowed the price of oil to rise. Note the chart in the bottom left. The drop in the price of oil, with increased inventories, brought about the idling of about 2/3 of oil rigs in the U.S. The higher price of oil has made it more economical to open up some of those rigs already. Because of this, oil would likely remain banded in the $60 a barrel range. In the short term, higher oil prices will likely lead to an increase of supply as active rigs increase to meet the demand. In the longer term, the price will likely rise as demand continues to grow at its historical rate while supplies are still seeking equilibrium. Demand will be driven by economic growth, while supply can be somewhat controlled by the oil producers. Expectations call for oil production to be greater than consumption in 2018. The job market is like any other market. It moves by the forces of supply and demand. When there is an oversupply of available workers, wages tend to be reduced, as employers don't have to offer much over the prevailing wages of their competitors. When employment tightens and there are fewer workers available, wages tend to rise as employers compete for available manpower. Since the last recession, unemployment came down considerably, but wages haven't been rising. That shows the softness in the jobs market despite falling unemployment. Recent economic activity has reversed this trend and wages are finally rising. One way we can measure the true level of unemployment is to consider the labor force participation rate, which is the upper right chart. This shows the percentage of the working age population participating in the labor markets. At under 63%, we are still at levels not seen since the mid-1970s, as reported by multiple media outlets. As the economy strengthens, the recent trend has arrested its descent, but it remains low. Some of the drop in the participation rate is attributable to people leaving the labor force due to aging. Some economists are predicting that the low unemployment rate will keep GDP growth rates muted. This thinking has some calling for immigration reform as a means to provide a supply of new employment. This is an area where I disagree with those economists. Although the official unemployment rate is low, the economy is not without prospects for new employment. The labor force participation rate is a source of sustainability for a continuing expansion. The rate is showing signs of stabilizing. The real jobs boom will be evidenced by a rising labor force participation rate. Consumer balance sheets are very strong in the aggregate. Total assets have reached new highs, while liabilities are very low. In fact, the amount that debts are costing households as a percentage of disposable personal income remains at extreme historic lows. Another thing to consider for the consumer is the fact that after 7 years, bad debts fall off credit reports. Access to credit adds fuel to consumer fires. We are beyond the 7-year point from the last recession. Consumers have greater access to credit and more spending power than they have had in a decade. Another thing to note about this is that rising interest rates won't have a strong direct impact on consumers' balance sheets. 2/3 of their liabilities are fixed in mortgages, which won't be directly affected by rising interest rates. The federal government's finances have improved from the last number of years. At the peak, the federal government was borrowing more than 35 cents of every dollar they spent. However, in the last couple of years, the borrowing rate has grown from a low of about 12 cents for every dollar spent to 19 cents for every dollar now. The long-term forecast calls for borrowing rates to increase going forward and at an increasing rate over recent quarters. It's interesting to note that Congressional Budget Office expectations for GDP growth reflect the current year's numbers, but they fall back to the previous trend of less than 2% GDP growth going forward. If higher rates of growth are realized, this can help federal finances through greater tax revenues. Only time will tell. Manufacturing indices are extremely healthy. It's not often we see all areas of the world growing robustly at the same time. This shows the breadth and strength of the global economy, and it is stronger this quarter than last. Inflation remains very tame, well below historical averages. However, there are areas of the economy with greater than average inflation rates. Unfortunately, some of the higher inflation items like food, housing, and medical care affect everyone, while some of the lower inflation items like recreation and transportation don't affect all economic participants. The future will likely see a return to more normal rates. If economic growth rates accelerate, higher inflation is likely to be one of the consequences, especially with an expanded money supply. Inflation assumptions can be a starting point for investment assumptions. Starting with low inflation and having it rise is a scenario we've seen 8 times since 1974. In this environment, equities and commodities have been the best performers, although I maintain that commodities number is skewed by the late 70s, and bonds and cash have not fared well in these environments. So let's talk about interest rates. After falling for the last 31 years, bond yields remain at historic lows as measured by the 10-year Treasury. Average nominal yields have been around 4%. This means that the nominal yield on the 10-year Treasury would have to rise over 1% just to get back to historical averages. The long-term outlook for interest rates is a rise toward the long-term averages. The movement of interest rates will impact bond investors as they watch their values fall. Falling bond values will also make bond holdings illiquid, as asset bids may not match realized results when sold. This is a dangerous environment for bond investors, as rising interest rates may counter coupon payments and remove the reward side of the risk-reward equation. When interest rates return to their mean value, how much more can be lost in the bond markets? From current levels, a 1% rise in interest rates will see more than 17% lost in 30-year treasuries and more than 8% lost in 10-year treasuries. Those with significant bond holdings, especially in treasuries, should carefully consider their asset allocation. Among all bond categories, only convertibles, floating rates, and high-yield securities would see positive returns in this environment, and mostly due to their coupons. So far this year, as interest rates have risen, bond values are suffering. The Fed expects to continue on a path of raising the Fed funds rate. Market expectations show what has already been priced in. There is still some uncertainty with the Fed's ability to follow through for the long term. For one reason, we have some of the highest rates in the developed world already. Also, the Fed risks pushing short-term rates so high that we reach an inverted yield curve where short-term rates are higher than long-term rates. One telltale sign of impending recession is an inverted yield curve, where the short-term rates are higher than long-term rates. Despite flattening over the last 4 years, the yield curve so far remains positive. Expectations are that the Fed tightening interest rates should also lead to higher long-term rates as well. An inverted yield curve has been a consistent signal of impending recession. Many are watching for this signal, and since a great deal of short-term movement in the markets is driven by psychology, it could be self-fulfilling. It's worth watching, but it's not always reliable. Although it has preceded the last 7 recessions, there have also been false positives. Also note that people tend to borrow on the long end of the curve and invest on the short end. Higher short-term rates can be stimulative, while stable long-term rates may not be harmful for existing debts. It's important to realize what is happening behind the curve. The short end of the curve tends to be driven by the actions of the Fed. The Fed tends to raise the Fed funds rate during economic expansions, and it tends to get very high near the end of the expansion when the Fed is trying to cool off an overheating economy and keep inflation in check. Long-term rates are driven by supply and demand for bonds. As people demand bonds, the values rise and interest rates fall or remain stable. Investors are still piling money into bonds despite those long-term risks we talked about. This is holding rates low as short-term rates are rising. This scenario isn't a sure signal of pending recession. So what about equity markets? Well, between March of 2009 and the end of June of this year, the S&P 500 increased by 302%, excluding dividends, and that's a huge increase. There's hardly a period of time that is shorter than the period of time between when the client thinks it's too early to get in and the market analysts think it's too late. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that we've been through what's known as a secular bear market. There are really 2 phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from over 27 times earnings to their current level of just over 16. The yield on the S&P 500 is still competitive with 10-year treasuries. In recent quarters, investors were concerned about high valuations in equities. The PE ratio was approaching 1 standard deviation above the 25-year average. As the S&P 500 has just about held even, although in a tumultuous fashion this year, the PE ratio has now reverted back to the average. There are 2 parts to the PE ratio, and holding all other things static, earnings growth will lower the PE ratio over the long term, and we are expecting earnings to continue to grow. The question will always be how quickly stock prices move in relation to earnings. So the main reason to invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, earnings have picked up and have resumed their track to record levels. Economists are calling for earnings to continue their rapid growth in this environment. This chart shows the secular bears and bulls. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear market is about 14 years long, and the most recent one started in March of 2000. Is it over? Only time is going to answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. We are in the 4th largest expansion since World War II. However, we are coming out of the deepest recession in the same time period, with the weakest recovery. There is a lot of room for expansion with growth-oriented policies. This chart shows an economy that has not been performing in line with historical averages. There is room for growth in this economy. As mentioned earlier, strength in the U.S. economy helps to bolster overseas economies as well. Overseas valuations currently are more attractive than domestic markets. Would you want to go back in time relative to the S&P 500 and invest at the lower valuations? Well, that's kind of what is represented overseas. No investment is without risk, and this isn't a sure thing by any means, but the valuations are more attractive here than in domestic markets. Make sure your portfolio isn't too American-focused. Overseas diversification at this time can improve long-term returns. So what should investors be doing? Well, there's a great deal of cash relative to GDP sitting idle in the economy. The chart on the right shows that nearly $16 trillion remains on the sidelines in various cash equivalent accounts, and that's still higher than last quarter. That's more than both consumer spending and mortgage debts. These cash assets are non-productive assets for growth and a fuel for further investment returns when they're put to work. The chart on the left shows that cash investors, also those invested in CDs, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make money. Investors in CDs are accepting that they are not coming close to keeping pace with inflation. The main market alternative to stock dividends is to take on interest rate risk in the bond markets. As shown earlier, bonds aren't a good long-term proposition, in my opinion at least, if we realize rising interest rates. It takes courage to invest. Even though the market finished positive 75% of the years of the last 38, the average year saw an intra-year decline of 13.8%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets do become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor for long-term growth. The dip we've seen so far this year has only been about 10%, and the market is currently back to about even. Now, we'd all love to be able to invest without risk. If I offered someone an investment which would have an average annual return over 20 years greater than 7%, most people would jump at it, and that's the red line. But what that line represents is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis, which was at the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust even at the worst of it. Oh, by the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in a portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of greater than 50% in the S&P 500 to return back to that 7% average line. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have seen even better results. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can make growth a smoother ride for investors. There's another story here. If you look at the chart, you'll see the white boxes are asset allocation portfolio, and the green boxes are large cap stocks, and that's represented by the S&P 500. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every single year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may return to the normal situation where managed money beats unmanaged money 2/3 of the time. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against loss. Where is a good place for investment dollars in the sectors of the economy? Well, looking at sectors the same way we looked at asset classes, you find a similar story. Those sectors you find on the top will one day be on the bottom, and vice versa. This chart suggests that a contrarian investor selecting sectors from the bottom of the prior year may be rewarded in the following years. Another method of sector selection is going with the prevailing assumption that future interest rates will be higher than today's. In that environment, it would be good to have sectors that are positively correlated to Treasury yields. In other words, sectors expected to rise as interest rates rise. On this chart, that would be sectors other than real estate, telecom, consumer staples, and utilities. Financials especially are expected to do very well in this environment. That doesn't mean defensive investors should only seek securities in these sectors. They should simply make sure investment portfolios don't neglect holdings in these sectors if they agree with the investment premise. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 2.6% per year, the average investor has barely kept pace with inflation over the last 20 years. If they had simply held any one of the other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. And I'm always happy to review and answer questions. These disclosure charts can be a bit of an eye chart. I do post the slides to my webpage. If you want to read them more closely, please pull up the slides and you can zoom in and zoom out as needed. Thank you for reviewing the Capital Markets Review. I appreciate your time, I appreciate your interest, and I also appreciate your questions. Feel free to reach out to me. My contact information is on the slides, and I'd be glad to answer your questions anytime.